thanks for everyone who's joined our quarterly multi-asset webinar. You know me, Anton Eser, CIO, and Chris Eddy, head of multi-asset funds. We've got an hour of your time, so we would like to cover off kind of about 45 to 50 minutes just to go through a slide deck Chris and I put together, and then have a Q&A. In your screen, you'll see a Q&A function, so please just add questions that come along. If we see ones which come up at the point, we'll take them, but also kind of use them towards the end of the presentation. We are going to do our kind of repeats in terms of recapping on themes that we've covered off in the last 4 or 5 webinars. We're going to try and give you a longer term perspective on what's been happening in the last 3 or 4 months, and try and fit that into our themes, and try and not focus too much on the noise, but try and give you a longer term perspective as we go through this deck. So just in terms of recapping on the themes, I think for those of you who have attended this webinar and various presentations we've done over the last 12 months or so, will recognize a few of the things that we put up here. And we spoke in the beginning of the year, we call it Goldilocks or the 3 bubbles. And we put forward this kind of thesis, which we've been talking about for the last 6-12 months around the bubble in US equities, leading to a lost decade in terms of real return expectations in the US. We also then we spent a lot of time talking about tech, and we're going to go into that in the presentation today. And then we also talked quite a bit about the issues around US fiscal sustainability, as we've seen massive deficits over the last 10 to 15 years drive up debt accumulation in the US. And a lot of those themes are very much kind of focused on the US, because for a South African investor, US equities are now a huge portion of any retirement fund. But most importantly, and as we're seeing at the moment what's going on, it has significant repercussions for all financial markets, including our local market. We did focus a lot in previous sessions around opportunities outside of the US. That was a kind of a negative view on the US around all those points, but talked a lot about actually outside of the US into kind of certain developed markets, and in particular emerging markets and our local markets, is there are most certainly good long-term real return opportunities. And then finished off very much kind of always emphasizing this point around, well, real yields and bonds in the local market and in global markets have been the most attractive they've been in really almost 20 to 25 years, and our portfolio has been kind of positioned that way. So I'm going to hand it over to Chris, who's going to kind of talk quite a bit about what's happening in the last 4 months around tech. I'll spend a little bit of time then going into tariffs and capital flows and the economy. Chris is going to link that back to what's been going on in SA and also our own idiosyncratic issues. And then really most importantly is what this all means. Have we made any changes in the portfolio based on what's been happening over the last 4 months, and have the valuation opportunity changed? Kind of wrap up with that. So Chris, I'll hand over to you to talk about tech.
Thanks, Anton. Yeah, I mean, I think everyone dialing in the last sort of 2 weeks, everyone is sort of, I think, becoming exhausted by the extent to which kind of the tariff goalposts are being changed, and obviously that kicked off a lot of market volatility. But the reality is, if you look at US equities as an asset class, try to cast your mind back to sort of when DeepSeek came to the fore at the end of January. It seems like kind of almost a year ago. So much has happened since then, but it actually marked, that DeepSeek moment really marked the top of the market for the Mag 7. Really, it was around this concept of many of the disruptors that we've seen who have been the beneficiary of kind of the AI and tech boom over the last 2 to 3 years, really have been primed for disruption. They're sitting on sort of record wide margins. I mean, NVIDIA is the poster child for that. And really what DeepSeek kind of brought to the fore is that really sort of human efficiency, ingenuity driving to kind of greater efficiency gains often leads some of these incumbents with problems around sort of their broader margins. I mean, ultimately what DeepSeek showed is that you didn't have to necessarily throw more compute power at the problem. You can kind of code and program more efficiently in terms of training many of these models. And quite interesting just to kind of stretch that time horizon back over a couple of over a couple more months to January, and that was really pretty much when US equity markets topped and really proceeded to kind of start their sell-off long before some of the tariff announcements came to the fore. I mean, I won't spend too much time on this. We really have sort of touched on this theme in our Goldilocks, all the three bubbles. But really, the likes of sort of an NVIDIA, we had sort of flagged as really a kind of the nuts and bolts of that AI revolution, almost like Cisco was for the rollout of the internet in the last tech bubble. And the embedded assumption around extended dominance was really kind of baked into consensus expectations here. This chart just effectively talks to the fact how NVIDIA was set to sort of take their profit from about 4 billion in 2023 to nearly $250 billion in about 5 years' time. And what have we seen since then? Well, we've seen kind of DeepSeek come to the fore. Last night, we saw specific tariffs aimed at semiconductors coming to the fore as well, which also impact the economics. And over the last sort of 2.5 months, we've seen NVIDIA go from about 150 down to sort of 100. It's trading at about 110 now. That's about a 25% sell-off. But if you kind of use analogs from sort of the previous tech boom, going from 25 to 65 is not a 40% sell-off. It's another kind of 55% sell-off to get to that level. So we've seen previous companies, which really were the large incumbents, not the non-profitable tech companies, the likes of Microsoft, which went on to ultimately dominate in their field over the next kind of 20 years from the top of the tech boom in 2000, really take about 14 years to recover their high. So this is not a remark ultimately on the business model or either on how AI is going to change our life and be embedded in our life. It's basically around the price that you pay today has a significant impact on your forward returns. And that really is the thesis around US equities for us. And we've seen some of that come to the fore. So here we're just looking at different segments of the US equity market. We've got the S&P 500 is the dark black line, Mag 7's the dark blue line, and then you've got the more well-diversified S&P 500 equal weight, as well as those staid old boring businesses that really haven't been the beneficiaries of the tech boom, represented by the S&P 500 dividend aristocrats. And what you can really see is that it's been Mag 7 and tech and the expensive part of the market that's really been driving the sell-off in the S&P 500. And as we mentioned, that started long before kind of the April 2nd tariff announcement. So this kind of weak underperformance of US equities has been in play for a good couple of months. And interestingly then, as you kind of pivot away from the US and you look at other markets during this period of volatility, we've seen that developed markets outside of the US, South African equities, emerging market equities have all shown much more resilient performance during this period of market stress, obviously starting from much lower valuations and potentially less impacted by some of the market volatility that we've seen. So we've really seen kind of a bit of a pivot away from the long-term trend into US equities, into US tech that we've really seen over the last 2 years. What is quite interesting as well, and this again wasn't only off the back of sort of the tariff announcement that Anton will get into a little bit more on the so-called Liberation Day, but the US dollar has been weakening since the beginning of the year. So here we've got the DXY, so that's against the basket, obviously, of developed market currencies. But we've seen this consistent depreciation in the dollar on a year-to-date basis, kind of depreciating by about 10%, as measured by the DXY, at a time when capital flows have been moving out of US equities and US equities have been underperforming. Typically, one would normally see sort of that dollar strength in periods of market volatility, and this is certainly something that we are well aware of in terms of what this might mean over the longer term. And I think Anton will unpack a little bit more of that. But ultimately for us, I mean, if we had to kind of distill this view around our concern for US equities, it really is posing the question that are we at the end of US exceptionalism? Here we've just really shown the relative performance between S&P 500 and MSCI World ex-US, so that's developed markets outside of the US. And what you can see with that continual downtrend from about December 2009 has meant that the S&P 500 has consistently, for the last, call it 15, 16, 17 years, outperformed developed markets. And we know that over the long term, markets are cyclical. Where not only has the S&P 500 massively outperformed ex-US equities, but we've seen this massive value expansion in US equities, which we haven't seen outside of the rest of the world. And what you can see here, we've just plotted those two pink lines just to really show that kind of the change in kind of the delta or the slope of that line is starting to change. And it really looks to us like that this might be close to the end of US exceptionalism, Anton. I mean, kind of when you then kind of start laying in what's happening with tariffs, it really does pose that question.
Yeah, and I think that the reason why we wanted to lead with this point that Chris is talking about around what happened in January with DeepSeek, and US tech is to try and give some perspective that this is not all around tariffs, and this market or markets in general have a way of really focusing on what's kind of front and center and the noise, and every day we trade up and down, 5% down days, 5% up days based on what comes from the Trump administration, and that's a very random walk. We don't have any perspective as to what's going to happen next. I don't think anyone, including probably the Trump administration, doesn't have any idea what's going to happen next. And so for us, it's very important. We've emphasized a lot when we go into these webinars around our kind of long-term thesis, how we think about investing your capital, and how important it is for us to kind of trying to step back from all the noise and get a firmer perspective as to how we allocate that capital over the long term. So we're not going to give you any insight. I'm sure you've all listened to a lot of webinars where there's been a lot of forecasting on what's going to happen with tariffs and the like. But we're not going to give you any perspective on that. We're going to try and frame it very much in kind of a longer term perspective, and also frame it in that view that when we talked about Goldilocks or the three bubbles, we set out our view that the US equity market was in a bubble. We really were also very concerned about the bubble in the US bond markets in terms of deficits and the issues there. And we touched on crypto as well in that kind of our third element of the bubble. But the point that we made really in that one as well is that we have no idea when this is going to end. And we pointed to the 1999, 2000 bull market, which continued to go higher and higher and higher. And actually the randomness of what happened with the way that bubble kind of reversed was very difficult to point to. It's the underlying structure of the market and valuations and the euphoria which actually sets itself up for what we've been seeing over the last 4 months. So tariffs are super important, and we'll talk about why they are super important. But most importantly, super important for the long term. So just with that context, here's a chart which we put up in front of you, which I'm sure all of you are kind of super familiar with just how big the announcements have been over the last few weeks. And we're just kind of going to break it down to actually just linking up the assumptions that are made here around this kind of baseline tariff. This has added kind of the 125% on China. It's added the 25% on steel. It's changing by the day, really, isn't it? That's kind of the thing to leave us with. There's a Bloomberg tracker, which Chris, you were talking about earlier on today, which actually even incorporated the change of the tariffs around semiconductors and smartphones. And I think that the numbers kind of somewhere you said around
effective rate was still kind of around 20, yeah.
Around 20%. So it could be 25, could be 15 by the end of today. But the reality is that at that ballpark, tariffs go back up to levels we haven't seen since the infamous Smoot-Hawley Act in the early 1930s. So as we all know, it is a big deal. But I think the point which is largely being missed, and definitely missed by the Trump administration, is just how much the US has benefited over the last decades, in particular in the last 25 years, around global trade. And this chart is really interesting in that it shows two things. It firstly shows the dark blue line is global trade as a percentage of GDP. And you can really see since the end of the Second World War, this kind of increase from kind of low 10s to 50%, which we kind of peaked out a few years ago. the kind of constant increase in global trade as a percentage of GDP. As we know, the world's been globalized, and China came into the WTO in 2001, and that kind of process of globalization has continued. But then on the right-hand side, if you look at plotting net wealth in the US relative to net income, you can see that there's been a constant also increase in how much more wealthy the US economy has come as the world is globalized. So the reality is that the US has benefited, US wealth has benefited and most certainly correlated very closely with global trade. And you can see that in this chart here. And I think this is like a really critical point which is being missed in terms of how important global trade has been for kind of the US financial and economic system. So the bottom one is basically the trade deficit. So that's kind of net spending on foreign goods. The US obviously imports significantly more than they export. And you can see that plotted back since the 1970s, and really they've been running a kind of trade deficit now for pretty much 30 years. But the flip side of that is if you're buying goods in dollars from the rest of the world, China kind of importing goods into the US and across the board, Japan importing goods into the US, what do they do with those dollars? And the reality is they don't repatriate the dollars back into their own economies. They mostly reinvest those dollars into US assets. So the mirror image of the trade deficit is flows into US assets. And if you kind of think about that over the last 20 years, I saw a number last week where the total amount of foreign capital invested in the US has gone from $2 trillion to $23 trillion over the last 20 plus years. A substantial amount of money, $20 trillion plus worth of capital flowing into the US, bidding up the dollar as well. And that's meant that that now foreign holdings of US financial assets are materially higher than they were before, and actually a significant portion of the local market. So treasuries, US treasuries, 30% of US treasuries are held by foreign investors. 30% of the total corporate credit market is owned by foreign investors. And then on the left-hand side there, you can see US equities. Now, something like 20% of the US equity market is held by foreigners. That's a combination of central banks, a combination of corporates, a combination of pension funds, insurance companies, etc. And the interesting thing, which you'll kind of note, actually in the last 10 years, that you've seen a lot more flow into US equities. So previously, kind of these more institutional investors, sovereign wealth funds, central banks in particular, held bonds. There's actually been quite a decent flow into US equities. So the point really is that, yes, trade deficit is massive, but that trade deficit creates a significant bid for US assets, the dollar itself, US equities, US treasuries, and the total corporate credit market. And that is a really important point, just to kind of put into perspective around what is going on and what it means for US financial assets. Because the reality is that the market, and this is a thesis we put forward almost 6 months ago, around the market is really the economy. So if you look at the left-hand side here, you can see that in the US, significant exposure now to the stock market. But on the right-hand side, you can see that the correlation between stock and bond wealth and consumption is very, very close. So you can see back in 2008, as markets dropped, so consumption dropped around the COVID period. We saw the same. And on the opposite side is as asset prices are kind of going up, so consumption is very strong. So this kind of wealth effect has been really important for the US recession, so for the US economy. I kind of fit myself into kind of the point we're trying to make with this is that really the thing which we've seen around tariffs and around we're actually sort of seeing it when US equities came off in January, February. You can kind of see that if you look at this chart here quite closely, so that actually you can see we kind of topped out in terms of consumer confidence, around the end of 2024, and you can see that kind of decrease starting at the beginning of 2025. as markets started to come off, and really accelerating in the last few weeks, to the point that actually consumer confidence now in the US is really the lowest level. You can kind of see it touch that COVID level. It's actually below where we were in the 2008 financial crisis. So consumer confidence has been significantly hit. That's a combination of both uncertainty around tariffs, but also around volatility in financial markets, around what's going on in US equities. Every day you open up the newspaper, not that anyone probably opens up newspapers anymore, but you open up your web browser for your news flow, and you see the US market is down 5%. The next day it's up 5%. That volatility, that uncertainty, always impacts confidence. So a combination of really not knowing what your value of your wealth is, plus a combination of just not knowing what's going to happen next in terms of tariffs, and therefore in terms of kind of domestic consumption, unemployment. Like, that is really the unintended consequences of what's been going on here over the last 4 months. And so the damage is very much being felt in the US, in particular in what we call soft data. So confidence, both consumer confidence, corporate confidence, is kind of what we call soft data. Hard data is consumption, so retail sales, employment stats. Those numbers are holding up still relatively well, but soft data is really starting to come under a lot of pressure. So the reality is that this is increasing the probability of a recession. You hit confidence, and you ultimately, people get a lot more cautious. They get concerned about employment prospects. They get concerned about the value of their assets, and they start to retract. And that kind of creates the paradox of thrift. Paradox of thrift leads on itself and leads to higher unemployment. So really the reality is that the recession probabilities in the US have most certainly gone up. Where they are is impossible to kind of forecast. And in the end, we're not the ones kind of forecasting macro events. All we're stating and observing the fact that confidence markets are highly correlated with the economy. Markets are significantly volatile, and all confidence is at kind of all-time lows, and therefore 1 + 1 equals that you should expect. We expect a kind of growing level of concern around a recession. And importantly, what that really means is the impact that is having on deficits and potential deficits in the US. We talked a lot about this in our previous webinar. This is something which is super important in terms of what's been going on in the bond market. And I just want to touch on that a little bit before I hand it back to you, Chris. Is the thing which really has been going on in terms of the budget deficit in the US is we've been running in the US a record high deficit outside of a recession. So you can see here, this is a chart plotting back the deficit in the US back to the 70s. It did once go positive, but apart from that small couple of years where it did, it's been running a deficit for a significant number of years. But most importantly, you can kind of see that deficit was just under 7% over the last kind of financial year. But the point really is that when you go into recessions, your receipts decrease because tax receipts go down. Your liabilities go up because you have to pay unemployment benefits. And so really what happens, as you can see there in 2008 and then in COVID, is your deficit just kind of goes down substantially. So we're going into a high probability of a recession, into a scenario where we're running a deficit which is much more similar to what you'd expect in a recession. So the probability of double-digit deficits over the course of the next 6 to 12 months, timing is tricky, is incredibly high. And we had a scenario whereby 45% of the US debt market, this $36 trillion US government bond market, needs to be refinanced in the next 2 years. So significant amount of refinancing and concerns around kind of a deficit picking up. So what does that mean? And this is kind of something which is really unprecedented. I mean, we had a little bit of this in COVID, but it's about a week. It's about a week of it, yeah. And I've been doing this for 30 years, and always in a risk-off environment, and where equities drop, as you would expect, there's a bid for safe haven assets. Now, what are the safe haven assets? Well, it's the dollar, it's the reserve currency. So there's always an unwind of carry trades and back to the dollar. So the dollar always gets kind of bid up, and you take those dollars and you will typically buy some duration. You'll buy some US bonds, so kind of some short end, but some bond duration. So through all cycles, really over the last 35 years, with the exception a little bit of around what happened with COVID, which was kind of, as Chris mentioned, for a short period, normally risk off, hold longer dated treasuries and duration rallies. And what happened really, which was quite something in terms of, in our experience, in terms of market reactions, is that actually what you saw, some of those big risk off days, is you saw the bond markets selling off. You saw yields in the bond market in the US going materially higher. And there are a number of reasons behind that. One of the reasons, most certainly, is around this point. Firstly, that we mentioned around foreign owners of the US bond market selling and repatriating capital back to their own markets. It secondly has got to do potentially with this concern around the deficits. Thirdly, concerns around inflation, and then there's always kind of some technical market issue that we saw on the basis somewhere. But this is something which is something which we are, everyone is really closely observing. Is this actually what's happening with tariffs? And just to kind of finish this off before I hand it back to you, Chris, is it's clearly a change in global order. We know that we've been having a globalized financial and economic system for the last 25 years. There's a retraction from that. Yes, that could create inflation, but the critical thing is the impact it has on demand for US assets, flow of US assets out of the US back into other markets, and therefore this kind of reduction in dollar demand is having a big impact on US equities, US bonds, and therefore this kind of point you made around US exceptionalism. Most certainly what we've been seeing in the last few months is kind of consistent with that theme.
Yeah, it ties in very, very, very much so to that. I mean, I think to be clear, kind of the end to US exceptionalism isn't a comment on how innovative the US economy is, or what Silicon Valley is doing, what the next innovation and development will be out of a very dynamic economy. It's about talking about this point about how the rest of the world no longer feels necessary or at ease with necessarily recycling those dollars back into US assets.
Yeah.
They're taking their capital back home. And that's kind of what we've seen. And here, I mean, this is very short term. I mean, from that kind of 2nd April to sort of April 11th, so that was last Friday, just showing that kind of to see the US dollar, US government bonds, and really the S&P 500 all selling off in a period of stress is something that we haven't seen in a long period of time. And almost kind of sort of a little bit tongue-in-cheek is something that we're quite familiar with being an emerging market like South Africa, where during times of stress, we see capital flowing out of our bond market and our equity market, which leads to that currency depreciation. So just a very interesting observation over what is a very short period of time, but something to really keep an eye on over the next coming months and years. I think, though, one can very easily get sucked into the very short-term nature of some of the moves that we've seen over the last weeks and months. I mean, they're very important markers to be aware of. But back to this point that we've been making, the precondition of the market is very important here. We started the year at really kind of elevated valuations. I think we're at about the 98th percentile in terms of the CAPE ratio going back over the last 75 years. And we have seen, I think, peak to trough, the S&P sold off about 20% in dollars, just under 20% in dollars. And kind of you see this sort of market correction, kind of the knee-jerk responses to say, well, we can buy assets at a cheaper price, and does one buy the dip here? But really, if you're kind of stretching out and you're looking at the CAPE ratio, which we spent a lot of time talking about, kind of that move from, call it 37, 38 times, has only gone down to about 32 times with that 20% sell-off. So we're still sitting, looking back to 1958, with the CAPE ratio at about the 94th percentile. So even though we've seen this kind of correction in US equities themselves are still very expensive. And I think what's quite interesting is the last time we were at these type of levels was at the end of 2021, and we saw kind of in response to the big tick up in yields in 2022, our US equities had quite a steep bear market in 2022. It wasn't a great year for US assets, but then following this kind of AI boom, the market tracked back up to those record levels of valuation. The key difference now ultimately is where real yields are compared to where we were in 2021. So kind of, I think if you dialed into all those webinars or conferences in 2021, everyone was talking about TINA, there is no alternative, and more recently for the last year or two, that's turned to TARA, because there is a real alternative. You can put 2.3% real investing in US inflation-linked bonds, which is a completely different picture to locking in negative real returns when real rates were kind of -1, -2. There, you could invest in government bonds and guarantee getting a negative real return, or you could roll the dice and invest in equities. However small that probability was in terms of getting real returns from a CAPE ratio of 38, 39 times, it still was worth that gamble, because you were going to lock in negative returns investing in bonds. But that picture's changed completely. And I think the chart on the right-hand side does a great job of distilling that. I mean, so that's the excess CAPE yield. It's to understand how much additional premium there is from investing in equities relative to bonds at this part of the cycle. And in 2021, that CAPE yield was about 3.7% higher than where real yields were on government bonds. That kind of put it at about a medium valuation. So one can understand that, you know what, actually from that point, we had a little bit of a rollover, but actually equities tracked up back higher. But given where real yields are now, we're really sitting both from a outright CAPE valuation perspective, and also from kind of that excess CAPE yield perspective, we're sitting at the 90th percentile with really basically no premium over government bonds for investing in US equities, which really means that despite this 20% sell-off, the market valuations, and as you kind of stretch that time horizon out over the next 5 to 10 years, mean that even though we've seen the sell-off, the outlook over the next 5 to 10 years is still really bleak, and that last decade is still ahead of us in US equities from these starting points. And I think it's very important to stretch that time horizon out, because you can very easily get suckered into the short-term volatility and moves and headlines around tariffs. But it really is that point that at 32 times CAPE ratio, even if we kind of get long-term real EPS growth of around sort of 2%, which is what you see kind of over the very long term, kind of move to the average CAPE ratio of the last 25 years of 27 times, that's a real return of about 2%. But the point is that we're sitting at a starting point where you've had a marginal correction in valuations, but forward earnings expectations have not moved at all. We're sitting at a point of peak margins, peak earnings, together with peak valuation. So there's kind of almost a layered effect there. You've had a slight markdown in valuations, but no move yet in terms of consensus earnings expectations. And in an environment where global growth, as Anton's laid out, is certainly looking to soften, kind of the impact and the read-through to earnings, let alone the impact of tariffs, means that you could very easily see kind of a big markdown in earnings, which means that maybe that 27 times CAPE ratio isn't necessarily a target, and that longer term sort of CAPE median of about 20 times over the next kind of 5 to 10 years is potentially a target. And there you still have negative real returns to US equities. But what's interesting is we certainly see that markets don't necessarily go in a straight line. Yeah. And every time you've had sort of corrections, whether that's kind of the 2000 bubble stopped at about sort of 20 times CAPE, GFC went all the way down to 14 times. So there's really kind of a wide range of returns. And what we've tried to do in the table on the right-hand side is plot and shade all those combinations of sort of exit CAPE ratios, real earnings growth that deliver returns below where the 10-year real yield is on US government bonds. And you can see there's about 50% of the observations there, which really talk to kind of how poor a trade-off there is between investing in US equities now relative to real yields on operating defensive asset classes. So, I mean, really looking to kind of summarize up some of the market observations. And again, we're not kind of forecasting what's happening over the next 3 to 6 months here. We don't have any view. These are observations that we've made, but really certainly from a market price perspective, question needs to be asked in January, did that DeepSeek moment really pop the AI bubble? Are the disruptors set to be disrupted? And we've seen some of the price action talk to that. But there's a long way to go in terms of those valuations. Tariffs, as Anton laid out, really will see less dollars recycled into the US to support US assets, less foreigners buying US treasuries, less foreigners buying US equities. And when you're sitting at such an elevated valuation point, removing that bid really kind of creates a little bit of an air pocket below for US assets. Lower asset prices and the uncertainty around tariffs are both headwinds for economic growth. So that picture is changing, and we haven't seen earnings expectations being marked down for softer economic growth, but that's another risk that's certainly on the horizon. And as Anton mentioned, sort of the instability in the US bond market raises questions around how one diversifies portfolios over the long term to ride out shorter-term volatility. But despite the recent sell-off, I think for us, the key takeaway is that sell-off started before tariffs came into play on the back of elevated valuations and a changing narrative. And despite the move that we've seen, valuations still remain significantly elevated, which means that kind of the lost decade is still ahead for US equities in our view. If we pivot more to the local market, I think what's happening globally certainly does change the picture in terms of some of the risks that are being faced by the local economy, and as a result, local market and local assets. One is obviously in the face of sort of the global trade war that certainly has been kicked off in full steam from April 2nd, is around, we start seeing kind of a global growth slowdown, which some of the soft data, as Anton mentioned, is talking to. We know that South Africa is a small, open economy. We're very sensitive to global growth. And really kind of SA growth is at risk should we see a more broader trade war impact global growth. For whatever reason, we've seen South Africa being singled out by the Trump administration multiple times with elevated tariffs. So the more kind of SA-specific idiosyncratic risk as a result of kind of US trade policy is also an elevated risk. It all but seems set that AGOA is going to not be renewed come kind of third, fourth quarter of this year, to also have a knock-on impact on South African trade dynamics and as a result, local growth. So these two big headwinds to kind of global growth and SA growth comes at a time where we've seen sort of the impasse around the budget, which to raise questions around the stability of the GNU, and if not the stability of the GNU, the effectiveness of the GNU to pass many structural reforms. I think a couple of observations there we've seen has certainly been that the ANC's kind of drawn a line around spending and not really being open to cut spending at all. And the function of that is in an environment where you do have a hit to growth, what happens to kind of some quite bullish assumptions around the National Treasury is baked into SA growth, and as a result, kind of longer-term debt to GDP trajectory, which is really kind of the albatross around our neck from a South African perspective. And that's where all the SA-specific risk stems from. What we've just shown here is as a result of some of these more elevated risks from a South African perspective, really the Rand has pretty much round-tripped some of the positive momentum that we saw post the election. So here we've just plotted the Rand dollar in blue. We've rebased it to 100. So where the line goes up, that's actually the Rand strengthening relative to the dollar. And we've plotted that against a broad emerging markets basket. Because we are an emerging market, we know we're kind of at the whims of sort of global capital flows. It's a good barometer to understand how kind of the idiosyncratic risk of the Rand has performed. And you can see post-election sort of where those pink lines start, the Rand strengthened quite materially relative to broad emerging markets. And we've pretty much given it back over the last couple of months, really round-tripped that as elevated risks in relation to South Africa has certainly come to the fore. When we look at that from kind of understanding what sort of risk premium is being embedded into South African assets, and here more specifically South African nominal bonds. We've just kind of pulled up the SA 10-year nominal bond yield and compared that to US 10-year, and that additional spread one can think about as compensation for bearing SA risk. And really just plotted that median and kind of 2 standard deviation bands, and you can see where we are now post-election. Kind of April 2024, we were kind of above that average. That kind of compressed materially as a lot of the risks around kind of South Africa were priced out of the local bond market, and that's backed up since the beginning of the year as some of these risks are coming back to the fore. But where we're sitting right now, we're still kind of below 1 standard deviation. So really, SA risk premium remains compressed in our view, more specifically in relation to South African nominal bonds, because we had a period where South African real interest rates are at the same level that they were at pre-election. Kind of, you've got real yields in South Africa at 5%, and as we really think about building a portfolio that targets inflation plus 5.5%, South African inflation-linked bonds, as you've probably heard many times, we've spoken about this, create an exceptionally high hurdle for other asset classes to compete with in the portfolio, given the real yield that they embed. And you can actually see kind of the lighter blue line is the South African real yield on the right-hand side, and that's unchanged since pre-election, whereas nominal yields are some kind of 150 basis points lower than where they were pre-election. So kind of really that inflation risk premium has been completely priced out of the local nominal bond market. When we think about South African equities, again, the high real interest rates in South Africa, ultimately that reflect some of the South African risk, are a big headwind to a re-rating in what is ostensibly a cheap South African equity market. If you just look at SA equity valuations, the Cape is still kind of below that longer term average at about 13, 14 times. But given kind of the elevated real yields at 5%, the incremental premium for investing in equities relative to inflation-linked bonds is actually quite low, and much lower than what we've seen over the last kind of 25 years. So from that level, those elevated real yields really do create a headwind for re-rating of cheap SA equities, and also ultimately feed into our positioning where we're a lot more neutral on SA equities, whereas with inflation-linked bonds, we've got a very large overweight. Anton, you're going to take us through from a performance perspective.
Yeah, I'll finish off, Chris, but please, as I mentioned, put questions on the Q&A, just so we've got a few things to go through. We've got a few coming up here on it, so please add to that as we kind of wrap up on our bits. So then we kind of covered off just in terms of what's happened with asset class performance. Overall, we've updated this because there's obviously been a very volatile April. We would normally do it to the end of the quarter. We've updated in the last 11 or so trading days that we've had, just so we've got something more up to date. And on the left-hand side, we've kind of plotted the fund performance relative to the CISA kind of category over that period of time. And as you kind of would have expected, given the themes you've been talking about over the last 12 months, the portfolio has held up very nicely through this very volatile period, generating good positive total returns in a very tricky environment, and significantly outperforming the peer group. So that's kind of very much kind of a testament to the point that we've been making around, right now, and have most certainly in the last 6 to 12 months, is a time to really be cautious in how you allocate the portfolio. And we have been, and that's most certainly playing out in terms of the total return of the portfolio. Positioning wise, and we're going to keep this slide up here, Chris, as we move on to the positioning, because this is really the point that you've made around US equities, is that previously when we had this, that was a negative number. Base case, as you would expect, has creeped up, and I see there's a question around this on US equities, but let's bring that up when we get to it. But you can kind of see really that this kind of view around defensive assets versus growth assets is still very strong if you have a long-term framework in terms of how you allocate capital. So positioning wise, there's really not been a huge amount of change, and we'll talk a bit about that just in terms of the question that we have here around US equities. But the portfolio, just given the points that Chris has made, is still running that relatively large underweight exposure to US equities, an environment whereby, it's sub 2% returns, where you can get actually a better return profile from investing in defensive assets, for a portfolio which is all around long-term growth, allocating a big chunk of your assets to a growth asset class with a lot of volatility, which won't deliver that long-term growth, obviously makes no sense to us as long-term allocator of capital. It may go up 10% in the next 6 months or down 10% in the next 6 months. We don't really have an opinion on that, but looking out long-term, that return profile of US equities is super important to us. So I'll kind of move it on to the questions, Chris. We've got just around 10 minutes or so. So there's a couple here. The first one is around US equities, and then there's a follow-up one which I see here being posted around US bonds. But I guess firstly on US equities, obviously the obvious question which has been posted here is around, well, when do you buy US equities? Is there a frame of reference that you have? Adding to the question, is there a frame of reference that you have that kind of gives us a kind of sense as to when this market is something that we would begin to allocate more capital to?
Yeah, it's a great question. I mean, our process is pretty systematic in terms of how we try smooth and kind of ignore the shorter term noise and really look at the numbers. Ultimately, kind of our framework, and it's kind of what we've sort of laid out here in terms of how we think about the requisite levels in terms of compensation for owning US equity risk or any equity risk. So ultimately, one kind of from that longer term valuation framework, and it's quite interesting when you think about something like the CAPE ratio. It smooths out a lot of cyclicality in terms of earnings through the cycle to give you a view. But obviously the change in price is very responsive in terms of where the market is pricing risk as well. So we've kind of seen that move from sort of 37 to 32 times, which has kind of been that sort of 20%-ish. It's kind of slightly less than that now. But for us, kind of that frame of reference of about 27 times CAPE, which is that longer term average over the last 25 years, starts to become a point for us where we start to kind of close that underweight to US equities. And if you are in an environment where valuations continually kind of derate, we get kind of closer to that sort of longer term average since 1950, and we certainly take on board that there are potentially some structural changes in US equities. That's a point where you start adding more risk, and kind of if you end up kind of getting to the point where we were kind of GFC with a CAPE ratio of 15, then you're kind of all in terms of our max allocation within our diversified framework, which has kind of quite robust limits around it. So for us, it's very kind of responsive in terms of kind of the point at which we buy an asset class based off the forward return that entry point infers for holding an asset class over the next 5 to 10 years. And that's very much how we think about kind of asset classes in isolation, but this is a multi-asset portfolio. So there are also other asset classes. And for us, it's kind of how do we think about the risk asset class versus the defensive asset class. So with real yields at 2%, kind of we've got a sort of a maximum underweight allocation to US equities. If we have real yields drop to kind of zero or go negative, that completely changes kind of the reference point in terms of sort of those CAPE ratio valuations that I laid out previously. So there's a couple of things to consider, but kind of having that quantitative framework really removes the emotion from the management process, which for us is very key and helps us kind of look through the noise and through the cycle.
Great. Good. There's another one I want to hand over to you here, which is around commodities. So the question is, what is your exposure to commodities, and do you have a view on that in terms of how it impacts the portfolio? So
we don't own commodities outright as an asset class in our portfolio. But what's quite interesting to understand, and I'll actually just flick back to one of the earlier charts here where we looked at SA equities. The composition of SA equities we know has changed somewhat over the last kind of 20 years. We're not as commodity heavy as we used to be. Precious metals, gold, platinum don't make as much of a weight as they used to kind of 20 years ago. But compared to most other markets, commodities still have an outsized exposure in the SA equity market. What's quite interesting, if you look at like the resources index, with everything that's going on, it's up about 41% year to date. This was as at yesterday. And that has really been the contributor that's seen positive equity performance for the JSE All Share on a year-to-date basis. So understanding that we've got some embedded kind of commodity exposure in our SA equity bucket for us brings that additional diversification, which means that one doesn't necessarily need that outright commodity exposure. The other point as well, given that kind of our economy is quite geared to commodities as a whole, if you go into an environment where kind of commodities run quite a bit, as we saw kind of in the early 2000s post the tech boom, the delta to the local economy is also quite large there in terms of kind of exports as well as revenue from those commodity exports. And we saw that briefly in kind of 2021, 2022, following the invasion of Ukraine. So the portfolio is naturally kind of geared to kind of more of a commodity upcycle, which I think are a couple of interesting observations when one thinks about whether you allocate directly to commodities as an asset class.
So, I mean, it's a question following for me on this in terms of gold. Obviously, gold's done extremely well year to date. And I guess the point really is that within the SA equity market, there is a decent amount of exposure there.
Yeah.
Any thoughts from your perspective on gold?
Yes. So, I mean, any traditional relationships that I think most people have become accustomed to with gold have been completely broken in the last 2 years. Typically, it was always had sort of a strong relationship with real yields. The real yields would sell off. Obviously, there's no interest that one earns from gold, and gold would typically kind of derate in an environment where you had higher real yields, and as real yields would collapse, typically gold would rally as a result. But I think almost kind of tying into this concept of the end of US exceptionalism, of foreign central banks diversifying their reserves, we have seen over the last sort of 18 months a consistent bid from foreign central banks buying gold, which kind of talks to potentially a reason why that sort of long-term relationship might have broken down, but also the need for foreign investors looking to diversify away from US assets as well. And where does gold go from here? I mean, I don't have a crystal ball. I'm not sure, but there really is. It's been a one-way train over the last 18 months, kind of underpinned by this consistent bid, which often used to be there for US treasuries.
Yeah. Right. Thanks, Chris. So let's wrap up. Thanks everyone for your time. Hopefully we've done a decent job at trying to kind of give some perspective around what is a very volatile and noisy market. And I'll just finish off with trying to summarize that, which we've done, is that from our perspective, once again, taking a step back and viewing this all through a much longer term lens, is, you know, we had this thesis very much around the bubble in US assets and concern around fiscal sustainability in the US. And, you know, we were most certainly seeing elements of that fragility kind of start in January around this point around the AI narrative, and picking up over the last few months. So from a what are we observing, not predicting, what are we observing in terms of market behavior, is that you know, we are going through a kind of structural rotation in this kind of shift away from that US exceptionalism narrative, which is really early days. And so in terms of the way we are managing the portfolio, it's stick to that, you know, as you would expect from the way we manage money, stick to that long-term thesis, allocate capital, which is very much based on the kind of the return expectations that you have in front of you. You know, ultimately there will be an opportunity to buy US equities, no idea when, and it's going to be super important at that point in time to have cash, to have defensive assets to deploy, you know, when we start to see that entry point. So it's really carry on as usual from our perspective. And please, any more follow-up questions that you have, please send our way. I'd love to get more and more inputs. And yeah, good luck to all of you in a very challenging market. Thank you.
Thanks for joining us today. Cheers.